Hello, zero DTE SPY calendar spread. Now we heard everywhere that everybody's trying to trade in zero DTEs or zero date to expiration options, meaning that they are open in the morning and then you need to buy or sell an option and the expiry is actually in the evening or let's say in the late afternoon. And at the moment, this is a very hot issue, which I call them a bit roller coaster options. But here I did some examples, I did some real trading, so I let you know how I do and how would be possible to do some trading in zero DT. So have fun. So just to repeat, what is a calendar spread strategy? It's nothing else that you're selling. I mean, I do now a calendar spread, a credit spread, is that you're selling an option at the money and you're buying a kind of out of the money option, but most important is that it's not at the same date. It's called calendar. So in our example, actually I sold a 0 DTE straddle on SPY and I bought a 30 days DTE SPY strangle at this price. Just to look at it is like here you can see that this was the transaction that I sold a 477 put and call at those prices, resulting a credit of 164. And as a protection, I bought 2 ticks up and down the put and call, as you can see here, paying 810 debit. So I have a debit total of 6.56, which actually I did just in the beginning, as you can see, at 3:30 opening at the New York Stock Exchange, or let's say in Chicago, I would say. And I was just wondering now what's going on, because I was expecting that the SPY stays around this 477, and what happened is whenever it stays about this, you can really look the time value loss or the time decay of those options. So you can see here about 1.5 hours later, I closed the position. You can see here the straddle, and you can see now from 164 it went down to 131, and the 30 days strangle doesn't move that much from 810 to 817, so that is not really a big move, because actually the SPY itself more or less stays at this range of 476.50 to 477. If you want to see here the details, when I sold this at 78 and 86, you see I bought at 78 and 53. So the put option actually was the same price, but the call option had a time decay of, yeah, you can see 33. So this was quite heavy. I mean, I saw the market went down, but not really much. Maybe, as I said, half a tick or something like that, but not that much. But you can see the time decay loss of the call option. So I got a net profit of 0.225, including the $4 commission. Just the day before, you can see here on December 27, I actually did the same on a calendar on 0 versus 1 day. So that's another idea in looking a bit the strategy, selling the SPY straddle and buying the SPY strangle. And you can see here I have a credit of 0.41. So in other words, the selling of the call and put at the money are at that moment higher than buying slightly out of the money call and put. As you can see here, that I bought again 474, 478 versus selling the 476. So I got 0.41 credit. And you can see here too that a bit later on, actually that was the next day, I have to admit I did trade on the 26th and then actually on the 27th, because my computer has the time frame of Switzerland. But anyway, I closed the position roughly 3 hours or 4 hours later, that I paid 103 what I sold at 143, and now this is interesting, I actually only get 0.83 credit on this 1-day SPY strangle. And when you look here again, the numbers is that whatever I bought, these two here, the 27 at 71, and you can see that the put really crashed down, while on the 1 day was interesting that actually I profit even by the call side, or let's say I bought at 58, I've sold at 55, okay, that's unchecked, but then here I've really lost on the put side, buying at 44, selling at 28. So even in 1 day there is a fluctuation in volatility. So this is sometimes we cannot control it. So this is definitely a more speculative transaction, but probably that the profit is more attractive as well. But when you ask me now straight if I would do a 0 versus 30 days or 0 versus 1 day, so I really would prefer the 0 versus 30 days, because it's a bit easier to control than just 1 day. What are the takeaways when trading in these 0 DTE options? Well, calendar spreads are limited risk strategies. We know what we can lose, but still I would always recommend you to work with stop losses. You know, these trade so fast that obvious that once there's a trend, the direction of the SPY to go up or down, there's not really that you can follow it. That's why you need to put a stop loss, which it can be about 50% of whatever you invest, or something like that. I mean, this is up to you to put a stop loss. I just follow the market, and when I see that it doesn't move as I want, I just simply close the position. But I was here. I mean, what I want to say is you put stop losses maybe the moment you are not able to follow the market. We know these 0 DT options are highly fluctuating and always profiting from time decay. This is certainly a good thing, but as I said, it's good if the underlying more or less stays at the same. Here is a very interesting research by Tasty Trade that the time decay on these 0 DTE is about 20% in the first 2 hours of trading, 30% in the next 2 hours, and up to 50% in the last 2 hours. Now this is interesting because it's really what's gonna be is that in the beginning the time decay is okay, and always the more it gets the end, it gets really heavy, especially the last half hour. But then it goes so fast that actually, yeah, maybe you are lucky and you're on the right side, but it can be really on the opposite side, that SPY just gets out of this range which actually you define. And then it doesn't help you really the time decay, because after that it's very deep in the money, the option. So I mean, I recommend you to trade only the first 2 hours. And this is what I see out of experience, because in the first 2 hours the market is more or less in these options okay, that you can handle it. What I do is I take a profit of when I have reached 25% of the premium received of the short straddle. So let's say in the previous example I sold something at maybe 160, so I got about a quarter, which is about 40. So what I do is once I get about this 20-25% profit of the premium received, well, then I close the position, because I think this is what really is the thing about receiving this premium on the short straddle. Make a plan when you want to get out. If seeing that the market is too much increasing, decreases, stop loss, whatever, I would just close. I mean, you can follow, and after 2 hours, if it's not really working, just close the position. Well, this is my recommendation. And before, I already said, if you ask me what is better, if it's a 0 versus 1 day or 0 versus 30 days, well, I would say 0 versus 30 days is more attractive. I mean, it's more to control, let's say. It's a better trading. But on both, the volatility is really difficult to estimate if it's 1 day or 30 days. So they can really adjust the volatility, and you are long the option, and maybe there's a decrease in volatility, therefore you're going to lose in this position as well. So far, this DTE SPY, what I'm doing the next week, probably I will do some zero DTE on stocks. I just focus maybe on NVIDIA because I saw that the stock is always around 495 to 500. So it would be fine to do that. Again, I would have to do that on a Friday. I mean, on the date of expiration that is able to do for stocks. That is every Friday would be that an idea, just to see a little bit how the fluctuation would be in stocks like that, and in buying again a kind of out of the money straddle 30 days in order to protect yourself. Obviously, you need stocks which are really liquid, so you have definitely NVIDIA, Amazon or Google, all these stocks which really gives you the possibility to trade in zero DTE as well. Okay, folks, that's all. I hope that you have enjoyed. I wish to everybody a happy new year, happy trading too, that everything goes smooth as you like. Okay, talk to you next time. See you. Bye-bye.